a recent poll shows 21% of economists are starting to consider current monetary policy, quote, too restrictive. That's the most in over a decade, according to the National Association for Business Economics. This comes ahead of the January read on inflation, which the Fed is watching to help guide the path for rate cuts. Here to discuss this and more, we've got Tomas Philipson, who is the White House Council of Economic Advisors, former acting chairman during the Trump administration. And thanks for taking the time here with us today. So, from your estimation, even if this print comes out still in trend with what we've seen of inflation over the past couple readings here, what does that trigger the Fed to do, if anything?
Yeah, I think everyone is expecting sort of no change relative to last month in the month-to-month numbers. But since that's replacing a bigger number in the past, the year-to-year is going to fall quite a bit. It's sort of the expectation. I think the future of CPI is so driven by housing, as you know, it's 40% of the core. And housing has responded kind of strangely to the rate hikes. So the rate hikes are supposed to dampen demand in credit-sensitive industries, housing being the primary one. But what has happened is that supply has gone down because people are sitting on their houses. They don't want to switch mortgages from COVID sort of low-rate mortgages. So prices in the housing obviously has gone up with these rate hikes. It's kind of a counter to what we want them to do. It's been price inflation for 40% of the core due to the rate hikes. So I think how that's going to trickle down the next year is going to be very, very important for both how the CPI reacts, but also as a consequence how the Fed reacts.
And to that point, Tomas, how are you expecting the Fed to react? What do they need to see to really sort of dig their heels in and believe that they have inflation under control?
Well, I mean, I've been arguing a long time that they have the wrong framework. It's not just me. A lot of people have argued, this Phillips curve framework where they have to kill the economy to kill inflation. A lot of economists don't believe in that framework, even though it is the sort of book, instruction manual in DC in some sense. If you just take the two last years, in 22, we had very slow growth. We had rapid inflation. In 23, we had pretty strong growth, but inflation coming down. That's just an example of this Phillips curve relationship where, inflation is not driven, or you don't have to kill the economy to kill inflation, essentially. I think most economists think that this enormous monetization of the debt with a 40% money supply is the cause of this inflation, and it's going to wind off over time, essentially. But the Fed will react in a very predictable way, given that they have this, in my view, inaccurate framework that they're based on.
So do you believe that the Fed is going to be able to adequately stave off a recession, perhaps even any of the hard landing talk? And ultimately, what does that mean? I hate to continue, as many of us, using this airplane analogy of a soft landing or a no landing. What does the reality look like? And is that becoming more clear from your perspective?
Well, I think their framework is the wrong one. So if they're lucky, it's kind of if we have a soft landing, it's not due to them engineering it. Certainly they're the one who caused it. Everyone believes that, the monetization of the debt is the cause of the inflation, essentially. And the question is, can they, with this, in my view, inaccurate framework, be lucky enough to have a landing that takes place in a way that doesn't damage the economy? I think people are concerned, myself, that this growth is so leveraged, both on the public sector level. Obviously, we have a deficit that's the highest in a non-crisis economy, meaning outside COVID crisis and the financial crisis and wars, this is the deficits we've never seen in a successful economy. But also on the private side, people are taking out 1.3 trillion in credit card debt, et cetera. So it's a very leveraged growth, and that's what's worrying a lot of people, I think.
And Tomas, I want to ask you about some of the criticism of the Fed. I mean, we talked about the NABE poll. Economists haven't been this critical of the Fed being too tight since 2010. And of course, there's political pressure. How much does the Fed actually pay attention to this noise?
Well, they have, like I said, they have their framework. They try to stay independent, both of the market noise and the political pressure, obviously, that's enormous on them to cut rates in an election year. And I think they're pretty good at staying away from that kind of a disturbance, essentially. But I mean, what they have done, where in the economy we've seen most inflation is where they have intervened, right? So if you think of it, the sector of the economy where we've seen most inflation is in the price of credit. If you're a mortgage payer basically, and you go from 3 to 6%, that's 100% increase in your monthly payment for your mortgage. That's much more than gas, food, et cetera, that we usually talk about. And if you're a credit card holder, it's gone from 14 to 21%. So that's a 50% increase in your price of credit. God forbid you're a bank and you went from 0.5 federal funds rate to 5% federal funds rate. That's 1,000% increase in your price of credit as a bank. So I think people need to understand that, you know, we're trying to fight goods inflation with enormous inflation in the price of credit, and that obviously has havocs in the economy, and that's why people want it to ease up.
How can the Fed ensure that there's not a spike in inflation on the other side once they do take their foot off of the gas here? Perhaps not on hiking further, but on the other side of that, not cutting too soon and then seeing a ton of demand, and especially in an environment where we've already been remarking on the resiliency of the consumer, that prices don't spike once again.
Yeah, I think it's more of a fiscal issue. I think when the House came in and turned Republican, that put some restraint on the massive amount of spending we saw. I mean, it didn't completely eliminate it, but it certainly put a downward pressure on it. And I think that's the most important force here in terms of dampening a resurgence of inflation.
Tomas, thanks so much for taking the time here today. Tomas Philipson joining us to talk all things the economy and, of course, what the Fed's going to do with their next decision. We'll see what the data does in terms of moving the markets and the Fed. Thanks so much, Tomas.
Thank you.